All right, week 4 of my trading journey. This week I focused on showing up, learning the basics, and trying to understand the tools that I'm working with. Today we're going to go over last week's goals, the sentiment for this past week, where I'm at right now, what I've learned about Sharpe ratios, market regimes, my coding process, creating my own strategy in multi-charts, my takeaways from the readings this week, and then next week's goals. All right, so last week's goals were to learn and explain market regimes and Sharpe ratios. I have done that this week. Then 30 minutes a day on Power Language and Python. I've sort of done this. We'll get into more of that later. And then create a strategy and test it in multi-charts, handwriting it. I have done that one this week. Of course, ongoing 15 minutes every week, reading a financial news source. I have been doing this, could probably be doing it better though. This is the strategy development framework that we looked at last week. Right now I am in step 2, and this upcoming week I'm looking to move to step 3 of finding some research papers and actually using them to potentially create a profitable strategy, even if there's very low alpha. Sentiment for this week, still super captured by real estate, but hearing some more personal anecdotes from people in my life, keeping me very engaged in the topic. I'd love to learn more. Something I was thinking about that I heard someone speak about is how much code do I need to know? And this ties to the last point of output over input. It seems like the best way to go may just be have AI write the code, and I'm learning it by correcting any mistakes and finding any bugs, rather than me learning the basics and trying to write it myself just to have AI write it down the line. So Sharpe ratio, this is the first topic that I was looking to learn about this week. Sharpe ratio measures whether a portfolio's excess returns are attributed to the strategy itself or to luck. The Sharpe ratio is a numerical value, and the higher that value, the better the Sharpe ratio. It's best used to compare similar assets. So an index fund like the S&P versus the NASDAQ, since those funds have similar assets inside them, they should perform relatively similarly, and so you can compare Sharpe ratios to learn more about which is actually a better investment. A negative Sharpe ratio means that the returns of the asset are less than the risk-free returns. We'll get into that later. Sharpe ratios can be manipulated, so everything is calculated over a given time period, the returns and the standard deviation. So if you set that time period as long enough, you can make the volatility seem really low, and thus the Sharpe ratio really high. Then lastly, Sharpe ratios are based on a normal model of distribution. So in standard deviations over from the mean, 34%, 14%, 2%, it underestimates tail risk, things that may be modeled as, oh, you would never see that in a lifetime, totally could actually happen due to something called the herding effect that takes place in financial markets. Okay, so this is the formula for an actual Sharpe ratio. The return here, that is the return of the given asset. If you're doing a Sharpe ratio for ES, then that is the return of ES over the given time period. The risk-free return rate is going to be the returns of an investment that has essentially no risk. So like FDIC insured bonds, you can pretty much guarantee that you will get that return. You'll get the 5% from the bond. And then you have that difference in the numerator over standard deviation in the denominator, which essentially measures the volatility of the investment. The lower the volatility, the higher the Sharpe ratio, meaning the more consistent, in theory, the returns should be. All right, market regimes. What is the mood of the market at a given point? Typically, it's between two. It's either a momentum trend following market or a mean reversion market. And so momentum trend following markets tend to be more bullish, and it means the market is going in a direction. And so your trades are going to want to follow that direction. If it's a momentum market, trend following market that's bullish, maybe you employ a long only strategy and follow that trend. Whereas if it's in mean reverting behavior, this is typically in more of a bearish market. You may want to use mean reversion tools, Bollinger Bands, Z-score, different tools that are going to give you a strategy that focuses on trading towards the mean. So it could either be a short towards the mean or a long towards the mean, but it's in normally a bearish market. So the Hurst exponent, this, like a Sharpe ratio, is a number, and it tells you what regime the market is in. Is it in a momentum market, or is it in a mean reversion market? So with a Hurst exponent below 0.5, that is going to be a mean reversion market typically. And a Hurst exponent above 0.5, that is normally going to be a momentum following market. So this is a step-by-step guide of how to use a Hurst value and market regimes in your trading. What I really want to focus on here is steps 1, 3, and 4. So identifying the regime that the market is in. And this I would probably do, at least for now, with an indicator separate from the strategy. Or now that I think about it, it would probably be less work to just embed it in a strategy with just an if statement of do this in a momentum following market, do this in a mean reverting market. And that leads right into the third step, my second step. Select the strategy to match the regime. Certain strategies are going to work better in different regimes. You don't want to apply a trend following strategy in a mean reverting market. With algorithmic trading, like I said, this should be relatively simple with just our Hurst value as an indicator and then an if-else statement of what strategy to use. And then lastly, constantly watching for regime transitions. And this seems like the hardest part. You don't want it to be flipping between. If it's right at that 0.5 level, it's between mean reverting and momentum following. If you have an algorithmic strategy, you don't want the Hurst value to be flipping between, and then you're constantly using different strategies. So I think step 4 is going to take the most fine-tuning to figure out how to actually apply it effectively. All right, and then this is the paradox, the edge case. Like I mentioned, bullish markets are going to tend to be more momentum following, and mean reverted markets are going to tend to be more bearish. But if you have a lot of momentum in the bearish direction, a strong trend in the bearish direction, you can have a Hurst value of greater than 0.5 in a bearish market, indicating momentum market, because it is moving like a momentum market, just in the other direction than it normally does. And this is really important to note, especially if you have a long only strategy in a momentum market, because would you want to have a long only strategy in a bearish market? No. So this is something that I'm glad I learned about and sounds like it is going to save me a lot of headache. Then at the bottom, I just have a quick table. Using the Hurst value, determine what type of market it is. If it is a uptrend, use a momentum following strategy. If it is a downtrend, use a mean reversion strategy. If it's moving sideways, also use a mean reversion strategy. And then if it is a correction, it is going down in a trend, avoid longs, potentially avoid even trading here. It would take away a large chunk of time in the market, but until there's a solid solution that I figure out, it may be better to avoid trading this. All right, power language progress. How are we coming with learning how to code in multi-charts? So I can't find any tutorials on power language. However, that may be a good thing because it means not a lot of people are doing it. If you find something with a ton of tutorials on YouTube that all have millions of views, that means the market is very saturated and there are a ton of people trying to do what you're doing. So I'm not even too upset by there not really being any good tutorials. And multi-charts even says themselves, easy language is an equivalent. The principles of power language are basically the same as easy language, which is TradeStation's version of power language. And so I was able to find some, not very many, tutorials on easy language, so I did go ahead and take a look at those. I just learned some very basic documentation though, how to buy, how to sell, different types of orders. This was something interesting to note. If you don't give a specific quantity, it will automatically trade one contract for futures or 100 shares for a stock. But then this is what I was talking about at the beginning, in that I thought about before getting into Python, of needing to focus on outputs over inputs. What do I actually want? A strategy that can pass prop firms. What is the fastest way to get there? That should be all I'm concerned with. How do I get to the output? And I think by learning Python, I'm focusing a little too much on the input. If at some point Python is in that path of the fastest way to get to my goal, then I should learn it. Right now, it is not in that path, so I don't think I should be spending my time learning it. I should be looking at my goal, looking at my output, what do I want, strategy that can pass prop firms, work backwards from there. How's the fastest way to get to that algorithmically? Which is probably going to involve much more AI code than my own code, and through power language, not Python. But I did still handwrite a strategy because it was one of the goals for last week. As we can see though, it was very simple. Just buy if market position equals 0, which just means I'm not currently in a position. Buy at the next bar with a market order. So if I'm not in a position, buy the next bar at whatever price it's at. Then after that, if I am in a position, that's what market position 1 equals, or in a long specifically, and it's been 3 bars since entry, then sell on the next bar, market order. This just enters long and sells 3 bars later. Super simple. Again, this is more just the principle of doing it to learn it. Okay, so this was kind of funny. I tested it over a very short time frame, pretty much one day, and oh, look at the equity curve. It goes up, up, up. But the alpha is essentially 0, meaning I didn't find any edge. I just pretty much traded exactly what the market did, and the market happened to go up on this day. So I thought that was kind of funny because my first thought when I saw the equity curve, whoa, profitable strategy. And then it took me a half second. I was like, oh, I did absolutely nothing. I was just in the market the whole time and the market went up over that period. Here's just visually, you can see the entering a trade, selling it 3 bars later, entering a trade, selling it 3 bars later. All right, so now I was doing the 15 minutes of reading a day. Probably wasn't actually 15 and it wasn't actually every day, but that was the goal. Here are my takeaways from my reading. It definitely reinforced the idea that there's no right way to do things. I saw so many different people doing so many different things that work just based on interlacing concepts, but definitely not the same concepts. And I'm trying to identify core truisms that are cross domain in trading. And the biggest one so far is following big money. Do not try to fight it because there is just too much of it. An example, I saw this today. It was a global macro trader. So, an ICT trader might say, okay, the big hedge funds in New York need to fill sell orders, liquidity sweep, and we're going to follow that big money. This global macro trader mentioned, okay, also these hedge funds and just any automated trading, they're looking at this 50-day moving average. When it crosses this, since all of their strategies are somewhat similar, they're all going to enter longs without even human discretion. So either if I'm in a short, I'm going to want to get out of the way of that, get out of my position, or take a long off the back of that. So the impetus for that wasn't even a global macro event. He had to be aware of the big money moving in the market. That was very interesting. Another interesting thing, I don't know what it means yet. Blue chip stocks that have always been cash flow positive are projecting to be cash flow negative, like Amazon and Meta, I think, next year because of the absurd spend on AI infrastructure. And the idea is that it's needed. We're at a crazy time for the industry right now. It'll pay itself off later. What does this mean for the Magnificent Seven and the top blue chip stocks? Cash flow negative seems bad. Isolated. In this context, it seems good. Is it good? I don't know. I don't know what this means, but it was something that stood out to me. Oh, that's interesting. So I might want to look at it some more. And then lastly, just like in trading, where I would try to watch a trend fully establish itself and then take the back half of that trend, a lot of good stock picks are after a company has proven itself. This seems very obvious, but I think with companies, there's a tendency to get scared. Oh, I missed the move, which would be a totally valid concern with trading. But with companies and economies of scale, if they've grown this much and they're past the point of always fighting to not go into bankruptcy, they're probably going to grow a lot more. And that's just a mindset shift that I'm going to have to understand. All right, goals for next week. For the reading, I tapped into Motley Fool. There's a lot of information. I need to get much more acquainted with it. They have a bunch of resources for that, things to read, webinars. I need to take a morning, just sit down, get acquainted with it so I can get the most value out of it and learn the most. Next, get the gist of wholesaling. Doesn't mean I'm going to do it. I'm just really interested in real estate right now. It seems really cool. Hey, let me sit down for a morning, learn everything I can learn about it. If it still seems cool, then I can learn more about it. And then the actual meat and potatoes of this next week, the training goal that I want to do is have AI write me a profitable strategy for funded account parameters. And now this is going to be somewhat loose. I'm not looking at time frames. I'm not even looking at evaluation fees or commission or slippage or any of that. Just given the parameters of a prop firm, can it write me a profitable strategy? Then lastly, every week reading 15 minutes a morning on some financial news source. Okay, so that's it for this week. Just as always, as a disclaimer, this is just a journal of what I'm learning. It is not educational and in no way advice.